So I've made some updates on this presentation based on some feedback we had both from the last over the past few months, as well as our client feedback requests. We did some surveying to find out what people were interested in. So we've got some updates in here to address that. It's not that different, but a couple things here and there are worth noting. One thing people also that came up was, well, asked about giving heads up on market changing conditions so they could change allocations. And I was like, that's the point of what we do. Everything I'm showing you and giving you today is really the reasons why we make changes in portfolios. We don't need to have conversations with our clients and say, oh, hey, we should really make a change. We've already done it before you. And a lot of the times, by the time the headlines are talking about it, we've already made changes because of the data that I'm showing you today. So that's why what I show, I think is so important, is because these are the actual things that drive our decisions. They really are. It can't be more direct than that. And I'm not big on hiding what we do. This is exactly what I'm looking at and why. So you can actually follow along at home and go along that way. So here we go. This month, all right, strong versus weak indices. We're going to look at what's working, what's not. Seasonality, the best 8-month period of the entire 4-year election cycle is coming up very soon. And I'm very excited for that, but we'll show you when that comes and how that hits and what that looks like. And finally, the standard money flow stats that give context of the current market health. That is always worth noting. All right, let's dive in. The S&P, right? This is the S&P with a 50-day moving average. It hit new highs in this past couple of weeks, and that's been great, right? The market kind of went sideways. We had this great run in April, May, June, July. We're kind of and then we're breaking out again. And then, we're above the trend. Trend is good. No problem there. I don't typically show indexes, but I'm going to try to show them a little bit more often so you can get a context of that. But where it's interesting is you switch to the Nasdaq, it is not hitting new highs, right? It's a little more of a downtrend. The tops aren't really doing what I want them to do. So if the S&P is outperforming the Nasdaq, that's usually a sign that the market is not real strong at the moment. You want to see the growth stocks, the Nasdaq, growth beating value, and that's how I think about it. Right now, growth is not beating value, and that is a weak sign, right? But the trend is still good. The trend is in place. We're above the 50-day. That's just a good generic way to think about it. We did test it there at the end of July, but now we're mostly recovering. We're still doing okay. So let's look at the ratio of the two. You can very much see when growth leads, this is the part where the market went up the most. If you go back, right? When this happened is when growth led, right? This goes up when growth is leading. This goes down when the S&P is leading. It's trying to make a comeback, but the trend is actually somewhat negative. So keep that in mind. We're not in a real strong phase. Now, that doesn't mean that the market is going to go down. It usually just means it's going to struggle to go up swiftly. It's going to be a little more of a grind, a little more of a choppy sideways, and it can lead to a negative market. But at the moment, we're not seeing that. And that's why you start with these factors and then you look at the money flow and see where that could go next. Something I also show I talk about in the newsletter quarter or the monthly newsletter, as I really talk about bonds and how just useless they've been, and there are good spots and bad spots. I thought this is a great place to show where that's happening. So right here, we've got the 10-year treasury. This is pretty much a standard what you should be diversified into, and it's going absolutely nowhere. The trend, I could even argue, is somewhat down, right? That's not where you want to be. This is not helping you diversify a portfolio. It's actually creating a lot of lag, and it's actually pretty flat year to date. There's very little benefit. But I always talk about there are bright spots to the bond market, and this is one of them. It's floating rate. This is FLOT. It's just a very standard issue floating rate ETF. There are ones that are better than this. This is just a really good average example of this segment of the bond market, right? This is helping, right? This is not helping. It's adding volatility and not helping the returns, but this does. And this is what I really like. And when we look at doing the bond side of the allocations, this is where we want to be. We want things that add stability and have the, bottom left to upper right movement. We want it consistent. We want it stable. The point of that to me is stability, not about diversification or, an allocation question. It's about adding stability and lowering the risk or the volatility of a portfolio. So those are things that I'm thinking about. And that's why I kind of harp on that on the bond section in the monthly newsletter, the written one. So there you go. You can see a visual of it. I don't always get to do the visuals. All right, let's move on to seasonality. I thought this was awesome. But to be fair, first, I don't have a slide for it, but September, October, especially where we are in the 4-year presidential cycle, tends to be a rough patch. I wouldn't be surprised to see the market getting a little bit volatile August, September, and into October. But once we get through October, we are now in the strongest 8 8-month period of the entire 4-year presidential cycle. Why that is, I'm not exactly sure, but I thought the stats were fantastic on it. This is the best 8 months. That is from November to June, right? So 6 months in next year and the 2 of this. Really, it's about the next election. A lot could happen in there, but what's interesting is statistically, those periods are up 100% of the time since 1942. That's a pretty good indicator that we're probably in an okay spot. Doesn't mean there's not volatility. It never means that, but it means this period we're coming into, we're probably going to get a sell-off into that September, October, and then run up from there. So that's what I'm thinking about. But I think this is fantastic stats that the odds are it's going to be up a little bit or a lot. It's pretty steady. And I say that this will be the first time in this 4-year cycle that it doesn't, but it does have a good history of strength. So yeah, we're looking forward to that. But again, we're in a period that it could be iffy going into it. The money flow stats, long-term trend is still up. There's no problem here. It's above both trend lines, just steady. If we dropped into here, I would care, but we're just not. This looks good. Money is coming into the market. Money goes up, or the stock market goes up when money comes in. It goes down when money comes out. It's really that simple. It's not what the president does, what Congress does, what all these things. It's really about how people are voting with their dollars day to day. And that's really what we watch the most. On the secondarily, we're looking at a shorter term. Yeah, it's a little bit iffy. The last couple of days, last week, it's been kind of choppy. Not terribly bad, but not great. We're still in this band, this 200 to 200 range. It's really nothing is going on. It's just kind of a dull, dead market. Back here we had a big sell-off and then big push, a push up that I showed you earlier, the big run up. That's what it looks like. And now we're just not doing anything. We're just kind of grinding sideways. So I'd love and prefer a sideways grind into October, but hard to say what we'll see. But so far it looks like that looks possible. Looking at the indexes, S&P is the strongest. The weak ones over here, the Nasdaq and Japan and Latin America. But a lot of the big names are all fine. Small cap, EFA, the Dow is okay. It's generally more positive than negative on the indices, but that's not what we're seeing. Going into the sectors of the S&P, it's largely positive. We're looking at 8-3. That's a pretty strong thing. And we've got a couple trending up. That's healthcare and energy are trending. It's not always the best for the market. But over here on the weak side, we've got technology, industrials, and real estate. It's kind of odd. Nothing super interesting, but largely positive. It's hard to argue that this market probably won't have another leg higher in the future. The RRGs, watching the ducks go around the pond, they are all in the leading. They're all starting to turn down towards weakening. Doesn't mean they're going to crash, but they certainly could come down here and bounce. That would be a great little pullback to see. I'd love to have that happen, but it's hard to say if that's going to happen or not. It's really hard to, But for now, we're up in this quadrant as a positive, so I'm not super concerned about that. And then finally, new lows. We had a big spike down a couple days ago, and really we're back. We're really not seeing a lot of new lows. When we see a lot of stocks on the New York Stock Exchange hit new lows, we know there's a problem in the market. I mean, more stocks are going down than up, and we should pay attention. This is giving us no reason to be concerned about that scenario, because even when we come down into here, 200 is not bad. I'd like it to stay here in this range, sub 100. But, dips below are not a big deal. So they just kind of grind sideways and we're all fine right there. Not a whole lot to be concerned about on the new lows. So yeah, so takeaways. Value is beating growth. The Nasdaq is not beating the S&P, and that's not a positive. That's the biggest negative factor I'm seeing for seeing the market grow from here. That's something to keep in mind. But seasonality is also iffy as we come into these next 2 months. But then from there, we're in a very, very strong period historically. So that's something to look forward to. Just kind of get through this next little patch. Don't be too crazy. Don't get too aggressive. That's that. And money flow is all pretty stable. There's really not a whole lot of sign of problems. Even though we're in a rough period of the cycle, there's really not a whole lot to be concerned about. So far so good. Let's see how this plays out.